We opened the stock for sale at $4.50 a share. By 103, it was over $18. Even the big Wall Street firms were buying.
Now, here they're talking about the actual pricing of the issue. So they've talked to lots of investors, they've kind of built up a book of demand, but they haven't given the final pricing. And then they give the final pricing, and then the price jumps. Now, generally speaking, in an IPO, you want an increasing share price, but not too dramatically, because if it jumps too dramatically, it potentially means that you've underpriced the offering and you don't want it to drop. So immediately after the pricing, what tends to happen is that the investment bank or broker-dealer will get involved in price stabilization. And what that means is they will have the ability to issue slightly more shares if the demand is, or the price is increasing dramatically. And by issuing more shares into the market, that will dampen the demand because supply is expanding. And that's known as the green shoe option, which is usually a 15% over allotment option that the investment bank can execute. But if the share price drops, then what happens, the investment bank will go out and buy stock. And you're thinking, wow, they're trying to catch a falling knife, right? They could lose money. However, the investment bank, when they do the initial offering, will normally get a few key investors and they will offer those shares to those investors, but they won't actually execute on the trade. So they effectively will have sold more stock than they actually have in their inventory, will be able to deliver on. And if the stock price drops because they're effectively short, it means that what they then can do is go out into the open market and buy stock and then use that stock to satisfy those investors that they agreed that they would actually deliver the stock later to. And that's known as price stabilization. And generally speaking, that should mean that the stock price generally slopes upwards after the issue. In examples where it doesn't work, i.e. Facebook, what can happen is you can just run out of the short that you are in the stock, so you just can't afford to buy any more shares, otherwise you'd be making a loss because the share price is falling. But that is called price stabilization. Now,